Okay. All right. Good morning, everyone. Welcome to our second day on consolidation. We have discussed the main principles that are connected with consolidation in the previous session. What is consolidation? It is basically the parent and the subsidiaries merging of the financial data. We are presenting the parent and the subsidiaries financial statements as that of a single entity. Why do we do that? Because it leads to better presentation. It is a manner in which we are presenting the financial information by looking at substance over form. So it is not just that legal boundaries require the parent to prepare a standalone, the subsidiaries to prepare a standalone. It does not end there. Okay. This is the legal form. In fact, as I told you, in foreign countries, standalone is not mandatory. What is mandatory is consolidated. The consolidated financial statements will give an overall picture of how the group as a whole is performing. And obviously, the owners of the parent would be interested in what is the financial position of the group and what is the performance of the group. And depending on that, we have this particular standard on consolidated financial statements. Okay. So now coming back to our proper chapter as such, we saw by various 2-3 examples how the consolidation process actually flows. So in the consolidation process, what we are having is we will first of all do a line by line addition of all the assets and all the liabilities of the parent and the subsidiary. This is known as a 100% consolidation. Whatever be the stake of the parent in the subsidiary, as long as there is a control, the stake could be academically anything between 51 to 100%, though practically we know cases where even though the holding is little bit below 50%, if you can exhibit that we control the entity, you will be a parent, the opposite party will be the subsidiary, consolidation should happen. So when you control, you as the parent control the entire assets of the subsidiary. You are responsible for the liabilities ultimately, and therefore you as a parent are controlling 100% of the net assets of the subsidiary. And that is why in the first initial working of our consolidation, we will do a line by line addition of the assets and liabilities. When we talk about assets and liabilities, we ignore 3 things in this. The first one is the equity share capital of the subsidiary as well as the parent. We do not add both of them. The next one is investment of the parent in the subsidiary. And the third one is reserves. So all assets, liabilities, excluding these 3 items, are added line by line, subjected to consolidation adjustments, which we will look towards the later part of today's session. The next step that we do is we prepare the working note. We prepare note number 2, that is equity share capital. Whose equity capital are we preparing? Understand from whose perspective CFS is being prepared. It is prepared from the perspective of the owners of the parent. So whose equity capital will come? The equity share capital of the parent will come in the consolidated balance sheet. Then we move on to note number 3. And in note number 3, we are having in note number 3 your consolidated other equity. What is consolidated other equity? It is essentially the equity of the parent. And after equity of the parent, we are going on to add the post-acquisition reserves of the subsidiary. Why the post-acquisition reserves? We are adding the post-acquisition reserves because this is the period when the parent was in control that the reserves were earned. So we have earned this when the parent was in control, and that is why it is getting added. So this is note number 3. When you talk about working note 1, the first working note will be consolidated other equity reserve wise working. So if you have multiple reserves like general reserve, securities premium, profit and loss, capital reserve, so on and so forth, we do a reserve wise working. So this is the first working. The next working is we had eliminated 3 items while totaling. First one was reserves. We discussed the treatment. Second one was equity capital of the parent, already gone in note number 2 in the consolidated balance sheet. Working equity capital of the subsidiary and investment. Now these two things are going to be eliminated against each other in what we prepare the second working note, which is the cost of control account. Ultimately, when I consolidate the balances, investment in subsidiary is nothing but equity shares of the subsidiary. So they are kind of intercompany balances. So we eliminate them against each other. And finally, when we move on to the next working, it is NCI. If you have not invested 100%, then a part of the equity capital will also be attributed to the NCI. And the last and the most crucial working is reserves. Reserves will be classified into post-acquisition reserves and pre-acquisition reserves. A company, a parent will purchase the pre-acquisition reserves, It cannot consolidate the pre-acquisition reserves in the consolidated P&L because of the simple reason that these reserves were not earned when the parent was in control. It was earned prior to the parent gaining control in the subsidiary, and therefore pre-acquisition reserves also will go to your cost of control account. Okay. And finally, with all the adjustments that you do, you will balance all the accounts, the workings, you will finalize, add it up, and ultimately it will go to your consolidated balance sheet that should finally tally. So this was a brief summary of what we discussed in the last session. We then move on to the next part. Just a brief about what is NCI. So you can come to your theory section and write down about NCI. Now, what do you think is NCI? Sir, NCI means non-controlling interest. Who are non-controlling interest? These are those shareholders in the subsidiary who hold a portion of equity of the subsidiary, but they do not hold that much share capital which will give them a control over the subsidiary. So what do we do with them? Imagine the situation. You are having a subsidiary. In the subsidiary, you have invested and the NCI also has invested. You have a second subsidiary. You have invested and NCI also has invested. So basically, in each of these business entities, there are two people who are interested, the parent as well as the NCI. So can I say that my consolidated financial statements are essentially a partnership kind of arrangement where the parent is one partner and the NCI is another partner? It is a very crude form of understanding, but this is how it is. Ultimately, the profits of the subsidiary will be shared between the parent and the NCI, which is exactly what happens in a partnership. When the partners introduce the capital, whatever profits the firm earns will ultimately be distributed to the partners in the profit sharing ratio. Here, similarly, whatever profit is earned by the company by the subsidiary will ultimately be distributed between the parent and the NCI. And therefore, in a crude sense, we can say both of them have joined hands. And in a crude sense, I'm saying this is not how it actually is. In a crude sense, they have joined hands to do the business. Okay. And therefore, they will be entitled to the profits. And that is why, can I call NCI my creditor in the truest sense? Answer is no. वो आपका बराबर का हिस्सेदार है. He is exposed to the same variable returns the way you are as the parent. फर्क सिर्फ इतना है. The only difference is you have control, he doesn't have control. That does not make him no less an investor than you are. He is also an investor as you are. He is your co-investor, and therefore from a consolidated balance sheet perspective, NCI cannot be a creditor. NCI will go as a part of equity. NCI will go as a part of equity. So you can know in the AS21 regime, we used to treat it as a minority interest, and we used to classify it under a separate subheading, under a separate heading in the balance sheet. However, in Ind AS, NCI would be regarded as a part of other equity, and typically it would be shown below other equity under the heading of equity as per Schedule 3. So you can note this down. As per Ind AS, NCI is regarded as a part of equity. As a part of equity. It will be shown under the heading equity below other equity as a line item. As a line item. Okay. Now, so this is the first part. Now the question is, can this NCI have a negative balance? Can this NCI have a negative balance? Sir, negative balance कैसे हो सकता है? Well, NCI has invested some amount, and later on the subsidiary went on making losses and losses and losses, and NCI started to get its share of the losses also accounted, and therefore the balance starts to turn negative. The balance starts to turn negative. Can we have a negative NCI? Answer is, it is very much possible. The way you have a negative balance in profit and loss, a negative accumulated balance is shown under the heading reserves. Similarly, a negative NCI is possible. Okay. A negative NCI will not necessarily imply that the company has gone into liquidation. Okay. Much like a company with net worth, though it has with a negative net worth, though it has implications on the audit report where SA 570 requires us to comment on the material uncertainty of continuing in the future, just a negative net worth does not imply that going concern is affected. Okay. It may be a temporary scenario. Similarly, a negative NCI does not merely imply that you can recover the amount from NCI. You have to understand, NCI is an equity shareholder. These are generally limited liability companies. And therefore, if the NCI shareholders have paid the amount that is due on the shares, then they do not have even a single cent to pay thereafter. And therefore, we typically cannot call the NCI to pay this amount back to the company. However, a negative NCI is definitely possible. There is no harm to that. Okay, so just like components of equity such as reserves, just like components of equity such as reserves can be negative, you can write into bracket even net worth can be negative. Okay. Just like components of equity such as reserves can be negative, comma, NCI being a part of equity can also have a negative balance. Can also have a negative balance. That is essentially debit balance in working note 3 NCI account. Perfectly possible. Okay. No adjustments are needed further in such cases. No adjustments are needed further in such cases. Okay, so NCI can be negative. There is no problem with that. There is absolutely no problem with that. Okay, so with that background, I am leaving you with two, you can just note this down. With that background, I'm going to leave you with two questions for homework. You will be able to do that after we solve a couple of questions right now. Okay, we'll be doing some questions. Those two are very, very elementary. Okay, and that is why it's not even preparing the consolidated balance sheet. I will tell you what is to be done. You will be able to do it. Okay, so I hope that you have written this down. I'll give you another 30-40 seconds to just note this down, and then we shall proceed further. Are people watching? No comments on the screen, so I do not know whether anyone is watching it or not. Okay, Sairam, Mahinder, आप ही दो लोग हो जो respond करते हो. I hope you guys are there. Okay. All right. So this is the theory about NCI. We then move forward. So the two questions which I'm giving you for homework is question number 4, question number 5. Okay. We will be discussing other questions right now, and thereafter, when we come and revisit, I will give you a brief summary of each question, and later on, based on that, you should be able to, kind of solve this. Okay. So let us then come on to question number 6. Now, this is a proper question. From now on, we start with the questions on solving. I told you in the last class that I have uploaded the formats on the portal. If you have downloaded the formats and printed, nothing can beat that. Okay, it's excellent. We can solve as it is together. But if you have not, no problem, view the session. Later on, you can yourself do it. Okay, so this was just to save up on time. Okay, so come to question number 6. Given below are the financial statements of P and Q as on 31st March 20X1. Okay, now what are there? I'm having, this is the balance sheet typically given in the schedule 3 manner. Okay, you would be aware under the Ind AS balance sheet, we are having assets first, and below that you are having equity and liabilities. So under assets, I'm having first item non-current assets, property, plant and equipment 1,07,44,000. Then I'm having financial assets, in that non-current investments 5,000, 1,000, loans worth 10,000. Nothing is there here, so this is 0. Under the current assets, I'm having inventories 20 and 10,000. Then I'm having financial assets, in that trade receivables, cash and cash equivalents, giving total assets of 1,88,000. I think it's 88,000, no, 8816, yeah, and 66,000. Equity and liabilities, we have shareholders funds, in that share capital, other equity. Non-current liabilities, I'm having financial liabilities, in that long-term liabilities. Deferred tax liabilities, long-term provisions. Under current liabilities, I'm having trade payables and short-term provisions. Notes to financial statements, we are given the balances of general reserve and retained earnings as at the balance sheet date. And you are given the split of inventories, that is raw material and finished goods. With this data, now read what is happening further. On 1st April 20X1, the balance sheet is on 31st March. This is happening on 1st April. And that means this is immediately next day. Immediately next day. P Limited acquired 70% of equity shares. that is 700 lakhs out of 1000 lakh shares of Q Limited at rupees 36,000 lakhs. So what are you doing? You have made an investment. Is it a controlling stake? I told you typically more than 50% we take it as a controlling stake. Academically, it means you are having a controlling stake. Okay. The company has adopted an accounting policy to measure non-controlling interest at fair value. That is the quoted market price. So when I talk about non-controlling interest, there are two ways in which it can be measured. First one is at full value or at fair value, and the second one is at proportionate share in the net assets. The issue is, if I do proportionate share of net assets, I explained in the last session, the goodwill is known as partial goodwill. Why partial? Because that goodwill is entirely attributed to the parent only. Whereas if I take NCI at fair value, then this would represent the actual amount that would be paid to the NCI to get a stake from them. And therefore, this would be also having a portion of goodwill attributable to them. And therefore, in such cases, when NCI is measured at fair value, the goodwill that we calculate is known as full goodwill, which will be attributable to the parent as well as the NCI. Applying Ind AS 103. Accordingly, the company computed full goodwill. See, this they have again told you. The company computed full goodwill. Why full goodwill? Array NCI is at fair value. That is why full goodwill. Shares of both the companies are of face value rupees 10 each. Market price per share of Q Limited as on 1st April X1 is 55. Why am I given this data? Why am I given this data? This is the NCI on the date of acquisition. This is NCI on the date of acquisition. Okay, so with this NCI, we should be able to calculate the goodwill. We could do it either using Ind AS 103 or we could also do it using the cost of control account. We will be doing it using both the methods. Entire long-term borrowings of Q Limited is from P Limited. So whatever borrowings are there of Q, it is entirely from P. The fair value of net assets is 50,000 lakhs. Prepare the consolidated balance sheet as on 1st April 20X1 as per Ind AS 110. What is 1st April 20X1? Sir, this is the date of acquisition. So you have to prepare the consolidated balance sheet as on the date of acquisition. You will also have to ensure that it is as per Ind AS 110. Okay. One thing. What is 1st April? Sir, this is date of acquisition. So they have asked the balance sheet on the date of acquisition. So will I have post-acquisition reserves? No, you won't. This is the balance sheet the moment you have acquired the control. So you are not going to have any post-acquisition reserves. So in your working note for reserves and surplus, we will see that post-acquisition reserves will be 0. Post-acquisition reserves will be 0. Okay, fine. The next one is, you are given this statement. The fair value of net identifiable assets is rupees 50,000 lakhs. Whose this is going to be? This is of the subsidiary. Okay. Typically, this is of the subsidiary. You can have a look at the subsidiary's net assets. Okay. What are net assets? Well, it is total assets minus liabilities. That is essentially shareholders' capital and other equity. Both of them are 50,000. Both of them are 50,000. So in this question, though you are given the fair value, it is nothing but equal to the carrying amount. Okay. So this we can say that it is equal to carrying amount. This we can say that it is equal to carrying amount. Okay. No change in this. There is no change in this. Okay. And then we would be having the next part. This is the balance sheet as on 31st March X1. The acquisition is happening for 36,000 lakh rupees as on 1st April. So can I say that one entry is yet to be passed? Sir, which entry? P acquiring shares of Q for 36,000 lakh rupees. Is this entry reflected in this balance sheet? No, it's not. Do I have to reflect it? Obviously, you have to. Otherwise, if I proceed to start it as it is, where is non-investment in Q? Where is it visible? This non-current investment is only 5,000. Ye kaun sa? This will be some other non-current investment that P has invested in. This is not investment in Q. That entry is yet to be passed. So that entry we are going to pass. What will be the journal entry? Journal entry will be very simple. Investment in Q account debit to bank. Investment in Q account debit to bank. How much? 36,000 rupees. Okay, assuming it is rupees in lakhs, it is 36,000. So when I pass that entry, that is investment in Q limited debit, so investments will go up by 36,000. So this becomes 41,000. That is 5,000 existing plus 36,000. 5,000 existing plus 36,000. The second effect goes where? The second effect will go under bank. The second effect will go under cash and cash equivalents. 38,000 will fall down to 2,000. 38,000 will fall down to 2,000. Okay. So this becomes 2,000. That is 38 minus 36. Any other change in the balance sheet? The total is not changing. Broadly, yehi aapka balance sheet hai. It is just that from the bank, the bank balances have gone to the place of investments. And this changed balance sheet is what is your position on 1st April 20X1. The fair value is given of the subsidiary's net assets, which is equal to the carrying amount. So we have set right the question in place, and now we shall come to the solution. We shall now come to the solution. Okay. So now come to this format which I have shared with you. This is question number 6. This is question number 6. Okay. So now let us talk about the first step. The first step is to prepare the balance sheet in Schedule 3 format. I have prepared the balance sheet for you. Okay. You can have property, plant, equipment, goodwill, investment, loans, inventories, trade receivables, cash and cash equivalents. You can see NCI is shown as a part of equity under other equity. You have the remaining non-current liabilities and current liabilities. So this is your balance sheet in Schedule 3 format already prepared. In your examination, generally the question will give you Schedule 3 format balance sheet. So what you have to do, copy the balance sheet as it is, only introduce 2 line items which are marked in red. Ek to goodwill hoga and the other is non-controlling interest. Ye do introduce kar do, you are sorted out as far as the consolidated balance sheet format is concerned. The next step is consolidation notes. This is note number 1, assets and liabilities. What did I say? I told you that we have to consider all assets, all liabilities without making any adjustments, but ignoring 3 items. Okay. So here I will ignore 3 items. What are they? First one, investment of P Limited in the subsidiary Q Limited. Second one, I will ignore equity share capital of both the companies, P Limited and Q Limited. And third one, I will ignore reserves. Investment of P in Q goes in the COC account. Equity share capital of P and Q, uske liye we have separate places, and reserves we have separate places. So ignore these 3, copy the items as it is. Okay, as it is samajh mein aata hai, just do a plain copywriting. Okay, so now let us start by looking at this. First one is property, plant and equipment, I have taken this 1,07,000 and 44,000. Okay. So property, plant and equipment, copy it, 1,07,000 and 44,000. 1,07,000 and 44. The next one is non-current investments. Non-current investment is now 41,000. But how much can you take? We can take only 5,000. Why? Because 36,000 is investment of P in Q, which will go where? Sir, that will go in COC account. That will not come in note number 1. So we are going to take only this 5,000, and this 1,000 also is going to come in any case. Okay. So यहाँ पे I will be having 5,000. Here I will be having 5,000. What is this 5,000? This is essentially 41,000 minus 36,000. 41 minus 36. And in the case of Q Limited, I am having investments appearing at 1,000. I am having investments appearing at 1,000. Next one is loans. There is an adjustment relating to loans, but right now don't break your head on that. Okay, this is 10,000 only of P. Q does not have anything. So 10,000 and this is 0. Okay. Next one is we are having inventories. Inventories breakup is given. Inventories, the breakup is given. So we have to give the breakup. So raw materials 10,000, 5,000. Finished goods also is 10,000, 5,000. Fair enough. So raw material 10,000, 5,000. This is also 10,000, 5,000. So total comes to 20,000 and 10,000. These totals you can do it. Okay, these totals we can get it done right now. Okay, so ye ho gaya. Next one is trade. What are the other items? So I have taken into account inventories. This is also done. Then you have trade receivables 8,000 and 10,000. So trade receivables 8,000 and 10,000. Then I am having cash. So trade receivables are done. Then I am having cash 1,000 and 2,000, not 38. 38 tha, but we purchased those shares, no? So it is 2,000. Okay, so 2,000 and 1,000. 2,000, 1,000. Okay, and then we are having all items of assets are done. I told you ignore these parts. So share capital are kept on hold. Reserves are kept on hold. We then move on to the liabilities. 30,000, 10,000. Okay. So come to long-term liabilities. 30,000 and 10,000. Okay. Next one is deferred tax liabilities. Copy it as it is. 5,000, 1,000. Long-term provisions also 5,000 and 1,000. Okay. So deferred tax 5,000, 1,000. Long-term provisions also 5,000 and 1,000. Okay. And then my trade payables is 6,000 and 2,000. 6,000, 2,000. Short-term provisions 2,000, 2,000. So just write those two items. 6,000, 2,000, 2,000, 2,000. Okay. So this is the first step. Populate all the items. Have I seen the adjustments? No. Maine seedha I have taken the value straight away from the question. No changes. Okay. Now the next note. These are consolidation notes. These are not your working notes. Okay. So the next note is equity share capital. Whose equity capital will come? Equity capital of the parent is going to come here. Are we given the denominations? Yes. Somewhere it is written ₹10 each. Shares of both the companies are of face value ₹10. Parent's equity is how much? 20,000. That means 2,000 lakh equity shares of ₹10 each, fully paid. So you will have to write that. Okay. 2,000 lakhs equity shares of rupees 10 each, fully paid. So this comes to 20,000. This comes to 20,000. Okay. So now I have considered this part also. I have considered this 20,000 also. Okay. Now we move on to the next part. Consolidated other equity. Consolidated other equity. This is going to come from working note 1. From working note 1. So we will populate it later on. We then move on to working note 1, that is consolidated other equity. And here, now look at the position. We have to consolidate. So when I consolidate, parents' reserves are as it is. Basically, consolidation is a process that is parents' financials remain as it is. You are adding the subsidiaries to that. You are adding the subsidiaries financials to that. Parent you will not touch. Okay. Parent will be as it is. Only thing you are touching for consolidation is investment of parent in the subsidiary. Apart from that, parent will be as it is. You are adding. So therefore, reserves, everything will come as it is. So standalone of the parent P Limited. Standalone of the parent P Limited. How much is it going to be? Iska breakup is given other equity. Yes. Somewhere it is given here. Yes. Reserves and surplus is other equity only. Okay. This is other equity. Okay. So here, general reserve 1 lakh, parent, look in parents column, and retained earnings 20,000. So we will write this as it is. General reserve 1 lakh and retained earnings 20,000. This is directly from the balance sheet. This is directly from the balance sheet. Okay, so 20,000. All right. Next one we come to, so that takes care of general reserve and retained earnings. And if I check my P Limited's figures, all items I have considered. So this also is considered, except one, that is investment in. So with this, we have completed all the items of the assets, liabilities, reserves of P Limited. So P Limited's balance sheet, all items we have put in the appropriate places. Yes. So are you able to follow so far? Is it okay? Am I too fast? Is the pace okay? Please respond. Please respond. Is it fine so far? Is it fine? Guys, please respond. Is it okay? Yes. Anybody lagging? Anybody has any doubts? Sir, we reduced bank balance from P Limited. Why has it not increased in Q Limited? I wanted somebody to ask this question. Thank you, Arpita, for asking. Okay. This is not a fresh issue of equity shares. Remember, Q is not issuing equity shares. P Limited has purchased these equity shares from other investors. Sir, how do you know that? Aisa hi hota hai. It is how it happens. Okay, unless you have invested right from the very beginning, you have the only option to purchase these shares from the outside market. And therefore, the money that you pay does not go to the company. This money goes to that person who is selling the shares to you. Today, if you want to buy shares of Reliance, do you think your money to buy the shares of Reliance reaches Reliance Industries Limited? It doesn't. It reaches the one who is selling. So here also, when 36,000 is invested in, you are not giving it to the company Q Limited. You are giving it to the owners of Q Limited, to the earlier owners or the earlier shareholders of Q Limited. Q Limited is already incorporated. Somebody else held those shares. You are buying the shares from them. And therefore, Q Limited will not get even 1 paisa out of the consideration that you are giving. Okay, that is why the bank balance of Q does not increase, because it is not given to Q, it is given to owners of Q. Okay, so Arpita, hope that it's clear. Yes. All right. So Vidula has confirmed. So far it is fine. Let us then proceed to the next step, to investment in Q Limited. All right. Now, P and Q, everything is done. Q also, everything is done except these two items, which is share capital and other equity. So we now come to the share capital of Q. This share capital, what do I do? It is nothing but portion of it belongs to non-controlling interest, and a portion of it is what is the parent has invested in the subsidiary, what the parent has invested. So can I say that this 36,000 and this 10,000 to the extent of 70%, can I say that they are like intercompany balances? Yes. And therefore, I will have to eliminate them. What is the reasoning? One is they are intercompany balances. Second is I have to eliminate it because now these investments in Q Limited is being replaced by the net assets of Q Limited. These investments in Q in the books of P, each share of Q is a representative of the net assets of Q. I am removing that 36,000 and replacing it with the net assets of Q Limited. And that is why we have to remove this. Okay. So coming to my question, by equity share capital. Acha, will I eliminate the full thing? No, we will eliminate only what is your stake. So in COC account, you will have to write down what is your stake. This is for you to understand. So I have taken 70%, right? Here it is given. Acquired 70% of equity shares. Okay. So this is going to come here. Okay. So 10,000 into 70%. So this comes to 7,000. This comes to 7,000. All right. Next. Sir, 70% I eliminated. 10,000 tha, 7,000 I eliminated. I'm still left with 3,000. That 3,000 will go to NCI. 30% stake. And always for NCI, write down which method is being followed. In this case, NCI at fair value on the date of acquisition. Always make it a point to write it. You don't have to write which method followed. These words are not important, but this method of NCI at fair value on the date of acquisition is important. Acha, in whose books am I preparing this non-controlling interest account? In whose books am I preparing cost of control account? Sir, we are preparing it in the subsidiary. No, I'm not preparing it in Q Limited's books. Sir, we are preparing it in P Limited's books. Definitely not. I am preparing it in a third set of books, which we call as consolidated books, Okay. So by equity share capital 7,000, and here by equity share capital 10,000 into 30%. So this is 3,000. This is 3,000. Is it okay? Arpita, I hope your query got addressed. Okay. All right. So this is 3,000. Let us then proceed further. Reserves are there. Equity, did I consider? Yes. So now what is left is reserves of 40,000. Reserves are made up of two items, that is general reserve as well as retained earnings. Okay. So reserves will be analyzed in working note 4. So working note 4, general reserve. Whose other equity? Of Q Limited. That is subsidiary. That is the subsidiary. You never analyze the reserves of the parent. Parent though it's there. The subsidiaries reserves are getting added to that. So we will never analyze the reserves of the parent. It's always of the subsidiary. So general reserve, what is this balance? Sir, this balance is 30,000. 30,000. From where am I getting? From Q Limited's balance sheet. General reserve. Okay. Now this reserve, I will have to split it up. I will have to split it up. Sir, what do you mean by split up? Bifurcate karo usko between pre and post. Pre, post. Q Limited's balance sheet, this is as on 31st March 20x1. That is nothing but 1st April 20x1. There are no changes. Okay. So can I say that entire 30,000 is pre? Can I say that entire 30,000 is pre? Obviously, because it is as on the date of acquisition. It is as on the date of acquisition. Since it is date of acquisition. Either mat likho, don't write it here. On date of acquisition. So, will I have anything for post? Nothing. Zero. Nil. Shunya. Okay. Okay. And now this one, I will be splitting it into who is entitled to it. Working note 3, NCI account. Just note this part down. Note this. Yes. Okay. So I think you would have written this down. So coming to NCI by pre general reserve from working note 4. 9,000. And in COC account by pre general reserve. working note 4, 21,000. 21,000. Is it okay? Yes. All right. So let us then move on to the next part. General reserve is done. The next one is retained earnings. Okay. Balance in retained earnings is 10,000. This is on the date of acquisition. So as usual, do the split. Pre, post. Obviously, post is 0. Entire balance is pre. So this one, we will be splitting it between P Limited and NCI. 70%, 30%, 7,000, 3,000. Into bracket, where is this going to go? Working note to COC account. This goes to working note 3 NCI account. Okay, so do the postings by pre-retained earnings. Working note 4, 3,000. By pre-retained earnings. Working note 4. I think this is 7,000. This is 7,000. Okay. So this part is also done. That means I have considered this also. So all items are done. Yes. एक adjustment बचता है, that is intercompany loans. We will see that later on. We will see that later on. We will come to sir, the controlling stake. Aditya, read the question. This is 31st March X1. I think you're asking relating to this question. And the balance sheet is 1st April X1. That is the immediate next day. So in this case, it is practically the date of acquisition only. Okay. Now, suppose we have to prepare balance sheets later on. We have lot of problems on that. Okay. So don't worry. I will explain how the profit of the subsidiary is calculated and do it. This is just a very preliminary question. Okay. This is just to familiarize you with the steps. Okay. There are a lot of questions where we will be calculating. In fact, we will be doing problems where date of acquisition balance sheets will not come only. Later on dates will come. We'll see how to do it. Okay. We'll see how to do it. Okay. All right. By pre-retained earnings. So all the adjustments are done. Only that what you can say, intercompany loans, we will eliminate it in a short while. Okay. But at least I can do the balancing of the accounts. So first thing is you balance the cost of control. Balance the cost of control. 36 minus 7714, 20, 35. So this is 36,000 36,000. I am left with a 1,000 balancing figure by goodwill. This is your goodwill. Okay. This is the goodwill attributable to the parent. This is the goodwill which is attributable to the parent. Array, Shivashankari, I have the app with me. All the formats are uploaded. Where are you checking up? Because I had shared this before the lectures even started and Institute has uploaded it. Other students, please confirm whether the formats are available. It's there in the assignment section, in case you are wondering, Shivashankari. It's there in the assignment section. Okay. It's uploaded in the assignment section. All right. So there you should be able to download it. Okay. All right. So this is your goodwill attributable to the parent. Can I balance my NCI? Not right now, because NCI is appearing at fair value, and for that purpose they have given the fair market price of Q Limited is rupees 55, and NCI has how many shares? 700 lakh shares are belonging to the parent out of 1000, so 300 lakh shares will belong to the NCI. Okay, so NCI to balance carried down. To balance carried down. This is fair value. $300 lakhs shares into rupees 55. 300 lakh shares into rupees 55. $16,500. Can I now balance it? Yes, now you can balance this. 16,500. 16,500. So 3,369.15. So I get a balancing figure of 1,500. What is this balancing figure? This is also goodwill, which is attributable to the NCI. This is also goodwill, which is attributable to the NCI. Therefore, full goodwill is equal to goodwill from COC account plus goodwill from NCI account. This was 1,000 from working note 2. This is 1,500 from working note 3. This comes to 2,500. Important is this is full goodwill. This is full goodwill. Shivashankari, did you get the formats in the assignment section? You can check it. Okay. So full goodwill is 2,500. Okay. All right. So that completes working note number 3. That completes working note number 2. That completes working note number 4. And finally, I am having a working note 5, that is not working note 5, we can say elimination of balances. Okay. Intercompany loans. Elimination. We all know that intercompany balances cannot continue. we all know that intercompany balances cannot continue because I am preparing the balance sheet by merging P and S, that is P and Q Limited. Now, in the same balance sheet, I cannot have loans payable to and receivable from the same party. Okay. Now, when I'm merging, you must have studied in AS 14 also, creditors and debtors. When you merge, ultimately you will have to eliminate them because it is mutual indebtedness. So here also we will eliminate. So journal of P Limited, which one? This is the consolidated journal. Okay, this is not the regular journal. Okay, this is not the standalone journal. In the standalone, the receivable is very much going to be there. The payable is very much going to be there. This entry is passed in the consolidated books where long-term liabilities of Q Limited debit 10,000 to loans of P Limited. This is the asset 10,000. Being intercompany loans eliminated. Being intercompany loans eliminated. And where will this go? Adjustment column, note number 1. This will go in adjustment column, note number 1. So have you written this? Have you written this? Yes. So coming to note number 1, loans, this is P Limited eliminated, and long-term liabilities में दिख रहा है वो 10,000. So here also it is eliminated. Okay. These goodwill of 2,500 which I got, can I take it to the balance sheet? How? No other work is there now. So we'll take it directly to the balance sheet. $2,500. We'll take it to the balance sheet, 2,500. The NCI was appearing at 16,500. So where is this coming from? This is coming from working note 2. NCI is coming from working note 3. This was how much? This was 16,500. 16,500. Okay. But what else? Nothing else is left. Now just balance, total up, no other adjustments, at least at the moment. For this question, no other adjustments. So this is 1,51,000. 5 plus 1, 6,000. This becomes 0. 10 plus 5, 15. This is 15. So total comes to 30. 8 plus 10, 18. 2 plus 1, 3,000. 30 plus 10 minus 10 is 30. 5 plus 1, 6. 6. 6 plus 2, 8. 2 plus 2, 4. Okay. So totaled up P plus Q plus adjustments column, totaling it up. Okay. Note 1 is done. Note number 2. Post acquisition Q Limited. Is there anything? No, nothing is there. I am preparing balance sheet on the date of acquisition. So there are no post acquisition profits. So come to consolidated other equity, general reserve, working note 1, 1 lakh, retained earnings, 20,000. Total is 1 lakh 20. Total is 1 lakh 20. Done? Yes or no? Done? So now just populate these. Okay, just populate these figures. Property, plant and equipment was appearing at 1,51,000 from note number 1. This was 6,000. Loans became 0. Inventories were 30,000. Trade receivables 18. And cash equivalents 3,000. 18, 3, 21, 30, 51, 6, 57, 2 lakh 7, 2 lakh 8, 2 lakhs 10,500. Equity share capital, this is note number 2, which is of the parent, that is 20,000. Other equity, note number 3, which is 1 lakh 20. We have just now balanced. Remaining items, note number 1, 30,000. Then cash and cash. Yeah, this should not have come. ये formats में this is one issue that is there. Copy paste करते हैं. How is this going to come here? This cannot come as a liability. Okay. Deferred tax 6,000. Long-term provisions 6,000. Trade payables 8,000. Short-term provisions 4,000. Okay. So that completes, and then after this you should pray to God that your balance sheet tallies. Okay, 12, 12, 24, 30, 54, 74, 194, 2,10,500. That successfully concludes the first question. Okay. Consolidated balance sheet. Done? The whole balance sheet is not coming in the video. Okay. Anybody has any doubt so far? Anybody has any doubt so far? Anybody has any doubt so far? No doubts? So then we'll just write a couple of pointers. Okay. Couple of pointers. As such, the question is over, but just a couple of additional points. This is not a part of your answer. Okay. This is not a part of your answer. Acha, NCI here is calculated at fair value because it was given to you. Alternatively, NCI could be calculated using proportionate share of net assets. Net assets were how much? 50,000. We have seen share capital was 10, reserves was 40 of Q Limited. 10 plus 40 is 50, which was given in the question also. 50,000 into 30% gives you 15,000. So NCI at proportionate net assets would be 15. Alternatively, you can check these items. Inka total dekho. 3,000, 9,000, 3,000. The total comes to again 3 plus 9, 12 plus 3, 15,000. So if it were to be NCI at proportionate share of net assets, I would balance it after this 3. I would get a closing balance carried forward of 15,000. No goodwill would be attributable to the NCI. The only goodwill that would be 1,000 rupees, which would go in your balance sheet, attributable solely to the parent, attributable solely to the parent. No other changes would be there in the balance sheet. Okay. So first point, if NCI was to be calculated using proportionate net assets method, comma, NCI would be rupees 15,000. That is 3,000 plus 9,000 plus 3,000, balancing figure from working note 3. Alternatively, it could be rupees 50,000. This is fair value of net assets into 30%. This is the stake. So that comes to rupees 15,000. That comes to rupees 50,000. In such a case, comma, goodwill would be rupees 1,000 only from working note 2, partial goodwill attributable entirely to the parent alone. No other changes would be there to the balance sheet. So what would happen is, asset side goodwill, which is now 2,500, would become 1,000. Liability side NCI, which is there in equity at 16,500, would become 15,000. Both the sides 1,500, 1,500 would be reduced. Your consolidated balance sheet would tally at 2,09,000. Okay. So that is the only change. Okay. So this is the first extra point that we are having. Noted down. The second point, since data is given on the date of acquisition, comma, goodwill can be computed as per Ind AS 103 also as under. तो क्या होगा भाई goodwill? That is going to be something like this. Purchase consideration for 70%, 36,000. Add NCI at fair value, 30%. This is 16,500. How do I get this? 300 lakh shares into rupees 55. So this comes to 52,500 less fair value of net assets, which is again 100% of the net assets, 50,000. So 2,500 would represent goodwill. Which goodwill? Full goodwill. I will check out Mamta, right? How to, I think the notes are not available. I think so. Okay. So I'll try to think how to get it. Okay. Sir, if we show NCI at fair value, didn't it mean that goodwill of NCI is also included? Yes. Also in consolidated financial statements, we should show only goodwill of parent or both of parent and subsidiary question mark. Okay. So anyways, note this down. Now, who is this? K. Shivashankari has asked a question. Sir, this goodwill which is appearing at while showing NCI at fair value, it means goodwill of NCI also is included. Yes, that means this goodwill is attributable to NCI also. You can check here. Goodwill from COC is 1,000. This is attributable to the parent. Goodwill from NCI account, this is attributable to the NCI. So the total goodwill is 2,500, which comes in the consolidated balance sheet. However, many times what companies do is, they do not want all this. They will say, we will do the NCI directly at proportionate share of net assets. By doing it at proportionate share of net assets, you will take only the parent's goodwill, because this is going to become zero. This is going to become zero. Because if it were to be NCI at proportionate share, this part would not come. So this would not come. NCI carried forward would be straight away 15,000. So goodwill would not have come. Would in consolidated balance sheet, what we should do? In consolidated balance sheet, what we should do? It depends on the method. It's not mandatory that you have to follow NCI at fair value. Neither is it mandatory that you have to follow NCI at proportionate share of net assets. It is an accounting policy choice. The only implication is, if you record at fair value, we call it as full goodwill. If you record it at proportionate net assets, we treat it as partial goodwill. This will have implications when we do impairment of goodwill. When goodwill is impaired, who will bear the impairment loss? If it is partial goodwill, then because the goodwill is attributable only to the parent, the impairment of such goodwill would be allocated only to the parent. That is the consolidated P&L. If it were to be full goodwill, we would allocate the impairment loss on goodwill both to the parent as well as to the NCI. That is the only implication. Otherwise, from an accounting perspective, as per Ind AS 110, you are perfectly at liberty to choose either the fair value method or the proportionate share of net assets. Nothing is wrong in that regard. Okay. So that concludes question number 6, and along with that, it kind of cements your position on how do I proceed with solving the questions. How do I proceed with solving the questions? Any doubts so far? Shivashankari, hope your doubts are addressed. Okay. ठीक है. So that takes care of that question. Next one. Okay. Building and other PPE. Inventories, trade receivables, cash, trade payables. ठीक है. So then that concludes the first question. Question number 6 is done. What I'll do is today itself, I will upload this format on the portal. Okay. The solved question. Now I had uploaded the blank one. Now I will upload the completed question number 6 with all these workings for your reference. Okay. So those of you who have been unable to write, you can download it and have a look. But you have to remember one thing, that this whole thing, right from drafting the consolidated balance sheet to preparing the notes, working notes, additional adjustments, all these things should be completed within a span of 25 to 30 minutes. Okay. Only then you will be able to successfully complete your paper. If you take 45 minutes to 1 hour, please understand that you are going to lose out on 15 to 20 marks of missed time. I won't say you don't know, but because you have missed out on the time which you additionally invested in this question, you will end up suffering loss of time for the remaining questions. Okay. So that completes the first part. We then move on to the next set of discussions. Okay. All right. Fine. Okay. Don't write this now. I'll give you theory separately. But first, let us understand. Fair value adjustments and how do I do it in the consolidated financial statements. Okay. So example. First one. P acquires S 100% stake on 1/4/2021 for rupees 50,000. Okay. S Limited, this is the standalone balance sheet on 1/4/2021. Okay. Equity share capital 10,000. Profit and loss balance 90,000. You are having land at say 10,000. Fair value of this land is 50,000. Nothing else is there. You would have studied what is business, etc., etc. Sir, khali land hai, so it is asset. Let us not get into that. S Limited is a business. We are acquiring a business, so it is a business combination. We normally do it like this because that will help us to understand. That will, one second. Stake for 50,000. So this is 1,000, 9,000, 10,000. Fair value of the land is 50,000. Okay. $10,000. Okay. This is the balance sheet. This is a business. So this is how it looks like. Okay. And then you are also given S Limited's balance sheet at 31st March 2022. It did some operations. So equity share capital remains at 1,000. Profit and loss 20,000. Land is still there, 10,000, whose fair value is 50,000. And additionally, I will be having cash, 21 minus 10, 11,000. Okay. So this is the balance sheet as at 31st March 2022. Okay. Now, if I have to prepare a consolidated balance sheet, look at all the steps that we have gone through. Okay. Now, when I go through all these steps, as on 1st April, consolidated balance sheet, 1st April 2021, on the date of acquisition. Acha, before that, chote mein, if I have to have P Limited's balance sheet, P Limited 1/4/2021. This is P Limited standalone balance sheet. Chota sa balance sheet. Equity share capital 50,000. Investment in S 50,000. Okay. Bas. This is the only thing which is there with P. Now, if I have to prepare the consolidated balance sheet, step number 1, I will prepare the consolidated balance sheet format. Step number 2, assets and liabilities. Assets and liabilities. That is note number 1. Okay. Note 1. Assets and liabilities. So who will come here? PS adjustment total. PS adjustment and total. Just a second. Okay. So in the case of assets, I have land. P does not have anything. S is having 10,000. No other adjustments. This is going to appear at 10,000. Note number 2, I will be having the equity share capital of the parent. So equity share capital will be 50,000 here. Then note number 3, consolidated reserves. P का कोई consolidated reserves नहीं है. There are no reserves. And S, everything is pre-acquisition. So that will go in COC. So reserves in the consolidated balance sheet will be 0. Okay. And then working note 1, reserves, again nothing will come. Working note 2, that is COC account. That is my COC account. Now, in the COC account, it will look something like this. Investment in S, 50,000. Against this, I will eliminate equity share capital, 1,000. I will also eliminate the P&L because entirely it is pre-P&L, 9,000. So this comes to 50,000. This is 50,000. So I will be left with a balancing figure of 40,000, which is my goodwill. I will be left with a balancing figure of 40,000, which I call it as goodwill. Okay. So yahan pe I will be having my assets, land appearing at 10,000. Goodwill appearing at 40,000, and that completes my consolidated balance sheet of 50,000. Is it okay? So this is how the story would go about. Now, if I proceed one step further, P Limited balance sheet we have understood, so there won't be any changes to this. But now if I have to prepare the consolidated balance sheet as at 31st March 2022, okay. So suppose I prepare the consolidated balance sheet, as at 31st March 2022. What all things are going to change? Only one, the reserves will come. That's about it. Okay. So I will be having equity share capital of the parent, 50,000. Reserves, post acquisition, it was 9,000, it became 20. So 11,000 was earned after the company got the control. So 11,000 will belong to the consolidated reserves. So this would be 11,000. Asset side, I would still have land at 10,000. I would have goodwill at 40,000. And I would also have cash balance now of 11,000 as the asset. So this comes to 61,000. This comes to 61,000. Okay. So in both the cases, I will be showing a goodwill of 40. I'll be showing a goodwill of 40,000. Okay. From the COC account, whatever, whenever you do, 1st April or 31st March. My question is, what is the problem in this consolidated balance sheet? What is the problem in this consolidated balance sheet? Okay. All right. K. Shivashankari, if we record NCI at fair value in the consolidated balance sheet, okay, goodwill of NCI is included in it. But that goodwill will be shown as a separate asset. No, it's not goodwill of NCI, K. Shivashankari. What it is goodwill attributable to NCI. These are two different things. Goodwill of NCI means you are somewhere understanding that it is the goodwill that NCI has created. NCI has not created any goodwill. This is the goodwill that is arising on account of consolidation. This goodwill is attributable to two people. That is, one is attributable to the parent, another it is attributable to the NCI. And that is why we show it separately and total it up in the balance sheet as full goodwill. NCI will appear at the fair value in the consolidated balance sheet because that is an accounting policy choice we have adopted. Goodwill of NCI is not included in that fair value. NCI at fair value is an independent figure. Because NCI is at fair value, I am getting goodwill attributable to the NCI. And that is why we show that separately. Okay. All right. Coming back to this example, please tell me, is there anything wrong in this 40,000? Is there anything wrong in these two balance sheets? Is there anything wrong? Is there anything wrong in these two balance sheets that you are now seeing? क्या गड़बड़ है इसमें? What is the mistake? Let us proceed to calculate goodwill as per Ind AS 103. As per Ind AS 103. Purchase consideration 50,000. Add NCI 0 because 100% stake. So this is 50,000 less fair value of net assets. Sir, ये तो 50,000 है. So if I have to talk about my goodwill as per 103, there should not be any goodwill. Yes or no? But as per Ind AS 110, I am getting a goodwill of 40,000. Whether I prepare it on the date of acquisition or whether I prepare it on the based on the date of consolidation, my goodwill is coming in the balance sheet, which is a misstatement. As you have rightly shown. Aditya is saying, yes, assets are to be recognized at fair value, which has not happened in this case. This fair valuation is pursuant to Ind AS 103. This fact has been ignored when we prepared the cost of control account. This fact has been ignored. The goodwill is overvalued. The goodwill is misrepresented. And therefore, we will have to give effect for this goodwill. We will have to give effect for this fair value, not goodwill. We will have to give effect for this fair value. Is it okay? And therefore, where do I give the adjustment? How do I give the adjustment? And why do I give that particular adjustment? So how and where is one question and why is another question. First thing we will answer, why do we have to do a fair value adjustment? See, Ind AS 103 is very categorical when it says that all the assets and liabilities of the target company have to be taken over at fair value. Sir, why is it stressing so much at fair value? The reason is this. I have net assets of S, or what I will do is, let me split it up. Assets of S debit to liabilities of S to purchase consideration to NCI. Now you would have studied Ind AS 103. Assets of S would be at fair value. You do a fair valuation of assets. The liabilities also are at fair value. The purchase consideration could be in multiple forms. What are the multiple forms? It could be in cash, in which case whatever cash you pay is the value. It could be additionally in the form of shares or debentures or securities, in which case you take the fair value of those debentures or securities. It could also be in multiple other ways. In each of those ways, you are doing a fair valuation. It could be a deferred consideration. It could be a deferred consideration where you are taking the present value. Whatever it is, there is a fair value component attached, except for deferred consideration, where we take the value of the consideration that we will pay in the future and discount it to the present value. So all these items ultimately mean that even my PC comes at fair value. The NCI is valued depending on two methods. Either NCI itself at fair value, which is nothing but market price. Can I say this is fair value? Yes. The other one is proportionate share of net assets. That means These net assets are also at fair value. Whose net assets? Of the subsidiary. So can I say that these net assets are also at fair value? And therefore, can I say that the proportionate share of net assets would mean the proportionate share of net assets at fair value? Yes. And therefore, normally speaking, this also comes at a fair value. This also comes at a fair value. And therefore, now when I do the balancing, the goodwill that I am going to get, if all the other items are at fair value, automatically the goodwill has to come at fair value. That is the reason fair valuation under Ind AS 103 is so crucial and so important. You cannot calculate. You would have studied various ways of measuring goodwill in your intermediate level. Okay. You would have studied super profits method. You would have studied capitalization method. You would have studied average profits method. All those methods do not really mean anything in Ind AS. They are just some fancy estimates you are doing to calculate the goodwill. They are some fancy estimates. Otherwise, this is how the goodwill is being calculated. All the assets and liabilities are taken at fair value. You don't just stop at the recorded assets and liabilities, mind you. You even go further and take the contingent liabilities, if any, at the fair value and do the accounting. You do the accounting at the fair value. Contingent consideration, if you are paying, you will fair value the contingent consideration. Everything is fair valued, because ultimately when all the assets and liabilities, the standard uses the words identifiable assets and liabilities. So you have to identify each and every asset that you are acquiring, each and every liability that you are taking over. This will not only mean assets liabilities appearing in the books of S, it will also mean assets liabilities not appearing in the books of S. Whatever reasons, okay, they do not meet the criteria of an asset, they do not meet the criteria of a liability. In spite of that, we will do a fair valuation of those assets and liabilities and take it in your Ind AS 103 working. Why? Because ultimately the only non-identifiable thing is one and only goodwill, which should come at fair value. Goodwill calculate करने का और कोई रास्ता नहीं है. There is no other way. This is the only way as a balancing figure, and therefore the entire things that you are taking over, we go in for a fair value, and that is why the goodwill will come at fair value. These fair valuation of assets has been ignored under Ind AS 110 in the example that we have just now seen. We have ignored the fair valuation, and that is why it becomes crucial for us to do a fair valuation adjustment. We have all in all 4 fair valuation adjustments. First one, fair valuation adjustments of assets, okay, of assets, that is specially property, plant and equipment. Now, when I talk about fair valuation of property, plant and equipment, this is again divided into 2 categories. Non-depreciable assets, which we are doing right now, that is land. The other one is depreciable assets, for example, building machinery, whatever. Okay. Then the next one would be fair valuation of inventories, and the last one would be fair valuation of payables. Okay. So these are the 3 which are subdivided into 4 categories of fair valuations. Now, in this case, land should have been appearing at 50,000. It's appearing at 10,000. That is why we are having a goodwill of 40,000 rupees. Is it mandatory for the subsidiary to follow fair value model in its accounting? I repeat, is it mandatory for the subsidiary to follow the fair value or the revaluation model for its property, plant and equipment? It's not. Fair valuation is a requirement of Ind AS 103 whenever a business combination takes place. That does not mean that the subsidiary has to mandatorily follow the fair valuation model of its assets and liabilities wherever applicable. Okay, it's not required. So therefore, S would follow the cost model. Under the cost model, land would appear at 10,000. So S Limited's account is perfectly fine. P Limited standalone is perfectly fine. The problem is arising when we are going to consolidate. The problem is arising when we are going to consolidate. This problem arises only when parent subsidiary relationship exists. Parent subsidiary means what? Parent has acquired shares of the subsidiary. This problem will not arise if it were to be an amalgamation or takeover of a division. Why? Because in case of mergers, in case of takeovers of divisions, what happens is the selling company shuts down or selling division shuts down and all the assets are physically transferred. All the assets are physically transferred. Matlab, if it is land, there will actually be a transfer in the ownership of land. You would pay the stamp duty and get the land in your books. Yahan pe, in the case of parent subsidiary, parent will also exist, subsidiary also will exist separately. They do not exist as S does not close down. S will still exist as an independent entity. So S can follow the cost model of accounting. Only thing is when we are doing the consolidation, that point of time, we will have to do the fair valuation adjustments. Kahan pe karenge fair valuation? Where do I do the fair valuation adjustments? Well, you will do the fair value adjustments in working note 4. Fair valuation adjustments would be done in working note 4. What is working note 4? If you remember, I had told you it is analysis of reserves. In analysis of reserves, you will be doing the fair valuation adjustments. So take any reserve, for example, suppose I have P&L balance of the subsidiary. This P&L balance, I would normally be splitting it up into pre and post, whatever be the amounts. Okay, these amounts you would generally come to know because you would be given the balance of the P&L on the date of acquisition and you are given balance in the P&L on the date of consolidation. The difference between the two periods represents the movement in the post acquisition period, and that would mean post acquisition profits or losses. Now to the pre-reserves, you would do the adjustment. To the pre-reserves, you would do the adjustment. So here you will do plus or minus fair valuation adjustment. That is, in this case, 40,000 would be added here. 40,000 would be added here. Mera P&L kitna tha? It was 9,000. My P&L, if I am not wrong, it was 9,000 on the date of acquisition. On the date of consolidation, it was 20,000. On the date of consolidation, it was 20,000. This is 1st April. This is 31st March. So pre-profits would be 9,000 and post-profits would be 0 on 1st April and it would be 11,000 on 31st March. 1st April, 31st March. 20 minus 9, 11,000. 9 minus 9, 0. Now the question arises, why do I do a fair valuation in the pre-profits? Let us understand. This is the timeline. This is the timeline. Okay. Now, if this is my timeline, the control is being taken over on 1/4/2021. Is the company, the subsidiary, getting incorporated on 1st April? No. वो तो कई सालों से चला रहा है. Let us assume that this company got incorporated on 1/4/2018. Let us assume. Okay. So that point of time, this land was acquired for 10,000. That point of time, this land was acquired for 10,000. Today, when the acquisition is taking place, when the control is being acquired, this very land is worth rupees 50,000. So the movement in this land, kab hua? When did it happen? It happened before you acquired control. It happened before you acquired control, and therefore we will have to treat it as a pre-acquisition movement in fair values. We will have to treat it as a pre-acquisition movement in fair values. Is it okay? And that is why the adjustment will happen in the pre-acquisition reserves. Sir, pre-acquisition reserves means ye to land hai. If it is land, it will go to revaluation reserve. Why have you shown it in P&L? I will tell you, koi farak nahi padta. It does not matter. Ideally, yes, what you are saying is right. It should go in the revaluation surplus. Okay. Suppose we talk about revaluation surplus. We talk about revaluation surplus. Do I have any opening balance? I do not have any opening balance. This is 0. You can look at S Limited's balance sheet. There is no revaluation surplus. Simple cost model it is following. So therefore, this revaluation surplus, if I now divide it between pre and post, both of them are 0. Both of them are 0. Add fair value adjustment. This fair value adjustment is worth 40,000. So this total comes to 40,000. This is anyways going to be nil. So ultimately, what would happen is pre-reserves, where do they go? Sir, pre-acquisition reserves goes to your cost of control account. All right. So in the first case, if the 40,000 would be recorded in your P&L, entire 49,000 would go to your pre-acquisition reserves. That is your cost of control. So my cost of control account would look something like this. Pre-P&L would be not 9,000. It would be 49,000. It would be 49,000. Sir, if you take it in revaluation surplus, what is going to happen? In that case, my P&L would be 4,000. I would have a pre-acquisition reval reserve of 40,000. Is it going to really matter whether I show it in revaluation reserve or whether I show it in P&L? Farak nahi padta. It does not matter because ultimately the movement is happening before the date of acquisition. And when the movement happens before the date of acquisition, uska ek hi jagah, there is only one place where the pre-acquisition movements have to go. That is in the cost of control account. Because these movements happened before you acquired control. These movements happened before you acquired control, and therefore they will go in your cost of control account. Whether it is pre-P&L, whether it is pre-revaluation reserve, my goodwill ultimately becomes 0. My goodwill ultimately becomes 0. So when farak nahi padta, whether it is P&L or revaluation reserve, my friends, why do you want to spend time and open a separate account, a separate working note? You will say today, sir, kitna farak padta? What is the difference? 2 minutes ka job hai. But understand, 2 minutes also is valuable in an examination perspective. And therefore, what we are going to do is we will pass this adjustment in the pre-acquisition reserves, which are already appearing in the question, It doesn't matter where it is. It doesn't matter where which reserves they are. Ultimately, all pre-acquisition reserves go to your COC account, and the fair valuation will happen through the COC, through the cost of control. So here now the goodwill is 0. So therefore, if we check your consolidated balance sheet, this becomes 0, whereas land will appear at what value? Now the land will appear at 50,000. The land will appear at 50,000. Is this giving a correct picture? Yes, this is now giving a correct picture. Sir, what about the balance sheet as at 31st March 22? Here also the goodwill as such will be 0 and land will appear at 50,000. And this is how your consolidated balance sheet is going to look like. So the adjustment entry that we are going to pass, is land account debit, because land is having an upper valuation in this case, 40,000 to reserves. Which reserves? pre-acquisition or post-acquisition? Sir, this is going to be pre-acquisition reserves, 40,000. And that is how your fair valuation adjustment in the case of non-depreciable assets is going to be completed. Just one adjustment in the pre-acquisition reserves, and that will take care of the entire mistake that was committed earlier, which resulted in creation of goodwill, which was not even there in the first place. Okay, so now that is successfully mitigated. That error is successfully mitigated. Have you understood fair value adjustment first part? Have you understood? Have you understood? Please respond, guys. Please respond. Have you understood? Have you understood the fair value adjustment pertaining to land? Why it is pre-acquisition, etc., etc. All clear? All clear? Yes. K. Shivashankari, let me know if your doubt is addressed regarding NCI at fair value. Okay. When fair value will come in post-acquisition, that time it is a, see, fair value on the date of acquisition is important. Fair value on the date of acquisition is important. Later on, what you are going to do will depend on what S Limited is doing in its balance sheet. Okay. Later on, what S Limited does in its balance sheet is what matters. If S Limited carries the asset at cost, to that extent in the consolidated balance sheet, your asset will appear at 50,000. So in this case, S Limited in the standalone will show the land at 10,000 forever. But in the consolidated balance sheet, you will show the land forever at 50,000 rupees. Why? Because on the date of acquisition, when you acquired the land, it would be 50,000. If there is a post-acquisition revaluation, done by the subsidiary, then that data would be given in the question to you. Normally, for a post-acquisition revaluation, the entry would be asset account debit to reval reserve. So the revaluation reserve would again be analyzed between pre and post. And this revaluation reserve would then come in the post acquisition reserves, and ultimately it would sit in the consolidated revaluation reserve that will appear under working note number 1, later on under note number 1, and finally in your balance sheet under the head consolidated other equity. Is it okay? So fair valuation adjustment on post acquisition will be shown in that manner. Is it okay? Has everybody understood the first part? K. Shivashankari is saying, you still did not understand. Okay, fine. I will explain that to you. Don't worry. I think you're talking about NCI at fair value. Okay. Others, have you understood fair value adjustment relating to land? Have you understood? Arpita is confirming. Aditya, please confirm. Sairam, you are not there today. Mahinder, आप भी नहीं हो आज. Okay, so just confirm if you guys are there. Arpita has confirmed. Vidula, did you understand? Aditya, did you understand? Shivashankari, towards the end of this session, today's session, I will explain after 10 o'clock. Okay, I will explain after 10. Okay, all right. Any doubts so far? Any doubts? No doubts? Please respond. Please respond. Okay, so Aditya has also confirmed. So that takes care of the first part. That takes care of the first part. Now you understood where to take the adjustment. You can take it in pre-reserve. Any reserve is fine as long as you are doing it in the pre-acquisition reserves. Okay, Shivashankari, at least you understood this fair value adjustment. Yes, Please let me know if you have understood the fair value adjustment. Okay. Please respond. Vidula, samajh mein aa gaya? Yes. So that takes care of the fair value adjustment relating to land. Okay. Okay. All right. Okay. Fine. So now let us move on to the next step, to the next adjustment. I am modifying this only. Case 2. P acquires S 100% stake on 1st April 2021 for 50,000. Now, in place of land, it is building. You can take building, you can take machinery, any asset. Okay. So, in place of land, it is building 10,000. On 31st March 2022. On 31st March 2022, fair value is equal to 50,000. Building hai, so it is a depreciable asset. Building hai, so it is a depreciable asset. So building, this would appear at 9,000. That is 10,000 minus 1,000. 10,000 minus 1,000. Okay. So what will be your P&L now? Your P&L is going to be, it was 9,000. You earned 11,000 as profits minus 1,000 as depreciation. So 9 minus 1, 8 plus 11, 19,000. So your balance sheet is going to tally at 20,000. Your balance sheet is going to tally at 20,000. Is it okay? So this is your scenario. This is your scenario. Okay. So now we prepare the consolidated balance sheet on 1st April 2021. On 1st April 2021. And now the consolidated balance sheet is going to look something like this. Okay. Please pay attention. Abhi things start to get a little more interesting. Okay. So first thing is, instead of land, we are having building. Instead of land, we are having building. Okay. PS adjustment and total. I delete this because there is an adjustment that is going to happen. Now, remove this part. Okay. Now, working note 4. Reserves. That is my P&L. On 1st April, what is the balance? On 1st April, the balance is 9,000. The balance is 9,000. And if this balance is 9,000, this is on the date of acquisition. Entire 9,000 is pre. Entire 9,000 is pre. So post is 0. So that means to this pre-balance, there is a revaluation adjustment that is happening. There is a revaluation adjustment that is happening. And therefore, I will add fair value adjustment. What is the entry that I will be passing? The entry that you will be passing is building account debit. Building account debit to pre-P&L. To pre-P&L. This is going to increase by 40,000. This is going to increase by 40,000. And therefore, 40 plus 9, 49,000 is going to come here. So I will have my pre-P&L at 49,000. Ultimately, the COC tallies, there won't be any goodwill. In the assets and liabilities, because of this adjusting entry, one effect went in the COC account The other effect goes in note 1. The other effect goes in note 1. I will add 40,000 in the adjustment column and building will appear at 50,000. Building will appear at 50,000 and ultimately this is what is going to be your balance sheet. This is what is going to be your balance sheet. Okay? So is there anything wrong in this balance sheet? 1st April 2021. 1st April 2021 is 50,000. So is there any thing wrong in this or is it correct? Okay, Kumar Mangalam, 100% stake is simple than holding in between stake because NCI calculation is not going to be there. No more adjustments. That's right. Presently, I don't want to take NCI because right now I don't want you to understand NCI. You know NCI. Right now, I want you to understand fair valuation adjustment. That is the reason I am taking a very simple case of 100% stake. Okay. So you can clear cut see that where the effects are going. If I take NCI right now, unnecessarily we will lose time on dividing the profits, etc. That is why I don't want that to happen. I want you to understand the concept of fair valuation adjustments. That is why I have taken 100% stake. Okay. All right. So now tell me, 1st April 2021 consolidated balance sheet. Is there anything wrong or is it correct? What do you guys think? What do you guys think? Is there anything wrong or is it appearing to be correct? Is it appearing correct? Come on, guys. Same example. Only land ke jagah I put building. So Arpita is saying it is right. It's absolutely right. This is 200% correct. There is no change. I then move on to 31st March 2022. Where S Limited's balance sheet looks like this. Okay. And now I will prepare the workings, analyze the reserves, and let us check how the things move on. Let us check how the things move ahead. Okay. Now the P&L balance of the subsidiary is how much? The P&L balance is 19,000. Okay. So we move on to this P&L. This is 19,000. Okay. So out of 9,000 is pre. So post will be 10,000. Post will be 10,000. Okay. So in my reserves, I will be having this appearing at 10,000. Okay. I will be having land now, which won't be at 50 because it is suffering a depreciation. Because it is suffering a depreciation of 1,000. So it will come at 49,000. 50,000, there was a 1,000 depreciation that was charged. And that concludes my consolidated balance sheet. No other changes to the consolidated balance sheet. Okay. So now you tell me, is this balance sheet correct? Dekho, you will also understand that when I ask this question, this balance sheet is not right. Because if this balance sheet had to be right, then why would I take a separate example? Okay. I would say land and building ek mein kar lete hain. This is a depreciable asset. So instead of telling whether it is correct, you will have to tell me where the mistake actually is there. Where is the mistake? Where is the mistake? Okay. Where is the mistake? Your note number 1 would look something like this. PS adjustment total. Note number 1 would look like this. Land 49,000. Sorry, this would be land appearing at SK books mein land would appear at 9,000. then you would have cash appearing at 11,000. Because of this adjustment entry, there is a plus 40,000 that is going to come here. And this is 49,000. Okay. Note number 2, equity share capital of the parent. Note number 3, consolidated equity. It is the reserves of 10,000. That's it. The parent does not have any reserves of its own. Okay. COC account will be exactly like this one. The same COC account. No change in this. NCI account, hey nahi, because we have acquired 100% stake. Now you tell me what is wrong in this. It's not land. In this case, it is building. This case, it is building. Now you tell me what is wrong in this balance sheet. What is wrong in this balance sheet? Just think a little bit and answer. Just think a little bit and answer. Think and answer. Come on, guys. Please respond. What is wrong? Okay, I'm just writing the data. Standalone P was 0 and post acquisition profits, which is this 10,000. Yes, depreciation taken as pre. Exactly. Okay. Now see, 1,000 rupees was the depreciation which was charged by the subsidiary on the value of 10,000, on the cost of 10,000. Okay, cost was 10. Depreciation charged is 1,000. That means you have presumed that the life of building is 10 years and done the depreciation. You have logically presumed that it is pre and it is 10 years and 1/10 you have written off. When you revalue this building as per Ind AS 103 to 50,000, when you revalue it to 50,000, in the consolidated books, the building is appearing at a higher value. The building is appearing at a higher value on the date of acquisition. And therefore, don't you think that depreciation also should proportionately change? Array, if value is 10,000, depreciation was 1,000. Now your value became 50. How can I continue with the depreciation of 1,000? Can I logically continue with the depreciation of 1,000? Is it reasonable for me to even say that 1,000 was depreciation when the building was 10,000? 1,000 is again the depreciation when the building becomes 50,000. Kahan se it is logical? It is the same building. It is the same structure of the subsidiary. You have not bought a new structure. The same structure in the subsidiary's books had a useful life of 10 years. You depreciated 10%. Today at 50,000 value, you are depreciating only 1,000, the standalone depreciation. That means you are taking the value of the building as 50,000 divided by 1,000. You're taking it to be 50 years. Because of consolidation, can the substratum, can the real nature of the assets change? Can you say that because consolidation happened, life of the building went up from 1 year from 10 years to 50 years? Cannot say that, because standalone mein the life of that building abhi bhi it is 10 years, and that fact must be reflected in my consolidated balance sheet. That fact must be reflected in my consolidated balance sheet. So when is the fair valuation happening? When is the fair valuation happening? Sir, the fair valuation is happening of the building on the date of acquisition. It is happening on the date of acquisition. And because it is happening on the date of acquisition, we say that the movement in fair value up to the date of acquisition becomes a pre-acquisition reserve, However, the depreciation from now will be extra, That extra depreciation, I will charge it after the date of acquisition. Yes or no? When is the value increasing? Sir, the value is increasing on the date of acquisition. Matlab, if this is my year when I am preparing the balance sheet, the fair valuation happens at the beginning. So depreciation will increase after the date of fair valuation. Yes or no? Yes. And therefore, the depreciation will happen after the revaluation. But the revaluation has happened on the date of acquisition. So therefore, the increased depreciation will happen after the date of revaluation, which is nothing but after the date of acquisition. So can I say that the post-acquisition extra depreciation is there? That is a post-acquisition adjustment. Can I say that this is a post-acquisition adjustment? Yes, it is a post-acquisition adjustment. And therefore, if I have to calculate the depreciation, now it will look something like this. 50,000 was the value of the building. Useful life is 10 years. And therefore, the depreciation should have been 5,000. But out of 5,000, already 1,000 is charged. Sir, ye 1,000, when is it charged? It is charged by the subsidiary in the period 1st April 21 to 31st March 22. Sir, aapko kaise pata? Look at this balance sheet. The building was 10,000. This is the date of acquisition. This is the date of consolidation. So after the date of acquisition till the date of consolidation, this is my post-acquisition period. 1,000 depreciation has been charged in the post-acquisition period already. And therefore, how much is the extra depreciation that I will have to take as a consolidation adjustment? I will have to take the extra post-acquisition depreciation as 4,000. And this 4,000 will come in here as an adjustment. Less additional depreciation. Kitna aega? This is going to be 4,000. And therefore, this will remain as 6,000. What will be the journal entry for this 4,000? Simple. Consolidated P&L account debit to building. 4,000. Consolidated P&L, or what I call is post P&L. This is better. Don't write it as consolidated, because ultimately we have to divide it between parent and NCI. Write it as post P&L. Where will these items go? This will go in working note 4. This will go in note number 1. So working note 4, I will have 4,000. This is working note 4, right? So post P&L 4,000 to building 4,000, note number 1. Is it okay? Yes. Are we clear about this? So if you go to your building now, in note number 1, it will appear somewhat like this, minus 4,000. So this comes to how much? 45,000. This comes to 45,000. What is your post P&L? Your post P&L is going to be 6,000. Post acquisition P&L is going to be 6,000. So this is 45,000. This becomes 56,000 total. Reserves will remain at 6,000. So this is 56,000. Have we understood post acquisition adjustment relating to depreciable assets? Relating to depreciable assets. Did we understand? Did we understand? Are yes or no? Have we understood? Boys and girls, did we understand? Yes. Why it is a post-acquisition adjustment, where to give the effects. Have you understood or not understood? Yes or no? Nobody is answering. I would presume that you have understood, okay, because answers are not flowing. Maybe some problem this side. My screen is not refreshing the answer. Okay. So, okay, Aditya has confirmed. So this is correct. So when there is a fair valuation on the date of acquisition, we will have to give the fair valuation adjustment. This could be in respect of property, plant and equipment. If there is an upward revaluation, the movement in fair value will go to the pre-acquisition P&L, which is up to the date of fair valuation, up to the date of acquisition. Thereafter, any additional depreciation that is there will be regarded as a post-acquisition depreciation and taken to your consolidated reserves. Taken to your consolidated reserves. Acha, if it is opposite, downward revaluation hoga. If there is a downward revaluation, this downward revaluation, first effect is the same. It goes to the pre-P&L as a reduction, not as an addition. It goes to the pre-P&L as a reduction, first adjustment. Because of downward revaluation, what is going to happen? There will be a savings in depreciation. There will be a savings in depreciation. That savings in depreciation will go to the post P&L. It will go to the post P&L. And there you would do the adjustments accordingly. Okay. So this is your general understanding of the fair value adjustments relating to depreciable as well as non-depreciable assets. Non-depreciable mein only one thing is there, movement in fair value. That's it. Depreciable mein pre-acquisition movement in fair value, post-acquisition additional or savings in depreciation. So that takes care of the first part of my fair value adjustment. Okay. So we take a 5-minute break. It's 9:25 right now. We will commence at 9:30. We will write some notes about the fair value adjustments relating to fixed assets and then move on to inventory. Okay. Take a break for 5 minutes. Ram, 5 minutes break. Okay. All right. Welcome back. So this is our discussion on fair value adjustments. Kumar Mangalam, DTL adjustments, you have questions. Okay. Don't rush into things. Okay. I have to do a little bit slow because I don't know whether everybody is on the same page or not. At the same time, I also don't understand because the responses are quite few. Okay. So I repeat a lot of things. Deferred tax adjustments are going to come. Okay. How do we do the deferred tax adjustments? We will see that. There are some questions. We will be doing those questions. Okay. Fair enough. So this come to your theory now. We had last written about NCI. Below that, you give the heading Consolidation Adjustments. Consolidation Adjustments. You remember in note 1, we used to write P limited, S limited, adjustment column and total. So these consolidation adjustments means they are focusing on that adjustment column, what all can happen. Okay. So in this, the first one is fair value adjustments. Fair value adjustments. Okay. So when I talk about fair value adjustments, this is a very crucial one. Okay. This is an important one. So you can just note this down. Ind AS 103 specifically requires net assets of S limited to be taken over at fair values on the date of acquisition. On the date of acquisition. If fair values are not given, comma, it is reasonable to assume that book values equal fair values. This is academic interpretation. Okay, this is academic interpretation. However, in case fair values are be made. This is because S limited need not necessarily follow revaluation model for its assets in its standalone books. In its standalone books. Just because Ind AS 103 requires P limited to do so in case of business combinations. Business combinations. Okay. So this fair valuation is not pursuant to Ind AS 16 or Ind AS 38 or Ind AS 40. It's not pursuant to those Ind ASs. It is pursuant to fair value adjustments. It is pursuant to Ind AS 103. Ind AS 103 discusses about accounting from whose perspective? From the perspective of the acquired. Okay, so we are discussing from the perspective of parent. Parent should do the fair valuation, not of its assets. As they will follow. They are at liberty to follow the cost model. That is the reason why we are first of all having the fair valuation adjustment. Okay. Therefore, Okay. All right. Sorry for the technical snag. Okay. Hope we should not have any. Okay. Otherwise, it is always assumed. Therefore, unless mentioned otherwise, it is always assumed that S Limited would not have revalued its assets in its standalone books. In its standalone books. However, fair valuation needs to be done in the consolidated accounts, for which following adjustments become necessary. For which following adjustments become necessary. Okay. So this is an introduction about what all we have discussed. Why do we need to have a fair valuation in the first place? Okay. And let us then start over with A, property, plant and equipment. Property, plant and equipment. So this will be categorized into two splits. We'll do a bifurcation of this. The first one is going to be initial recognition. Initial recognition. What do I mean by initial recognition? That is on the date of acquisition. And then I'm having subsequent measurement, that is post acquisition period. Post acquisition period. Initial recognition, what am I going to compare? I am going to compare two things. Important is on the date of acquisition. I am going to compare two things. First one is fair value on the date of acquisition minus carrying amount. Minus carrying amount on the date of acquisition. I will compare this. Okay. Two possibilities exist if this happens. Okay. Two possibilities exist. The first possibility is an upward revaluation. The first possibility is an upward revaluation. PPE account debit. PPE account debit. Two, this would have happened because of the movement in fair value prior to the date of acquisition. The change is happening on the date of acquisition means the fair value movement would have happened before. So to pre-P&L. To pre-P&L. Where will the double effect go? PPE goes in note number 1, adjustment column. Whereas pre-P&L will go in working note 4. Pre-P&L goes in working note 4. Subsequent measurement, what do I do with this? This is essentially the additional depreciation or savings in depreciation. Okay. So, additional depreciation in case of initial upward. In case of initial upward or savings in depreciation in case of initial downward. In case of initial downward. Okay. In case of initial downward. All right. Fair enough. So what is the treatment for initial upward revaluation? There would be an additional depreciation, which would be after the date of acquisition. So that will go in the post period. So post P&L account debit to property, plant and equipment. So where would these items go in our standardized workings? Working note 4, and this is note number 1. This is note number 1. So this is additional depreciation. Additional depreciation. Fair enough? Or if I talk about downward, it will look something like this. Value goes down, it is a loss. So pre P&L account debit to property, plant and equipment. This goes in working note 4, and this goes in note number 1. This savings was corresponding to this, additional was corresponding to this, and corresponding to this you will have savings in depreciation. So PPE account debit to, not pre, to post P&L. This would go in note 1, whereas this would go in working note 4. Okay, so this is the treatment for property, plant and equipment. This would be the additional depreciation or the savings in depreciation, the journal entries. Okay. So in A, I can give this as the first bullet. This can be the second bullet. Okay. So fair value adjustments, this is how it's going to happen. Okay. Have you noted this down? Have you noted this down? Anybody has any doubt so far? Anybody has any doubts, any difficulties so far? Anybody has any doubts or any difficulties so far? I presume not. Okay, so just take a minute or so to note it, and then we shall proceed further. Okay, I'll wait another minute or so. Okay, so noted it down. Yes, no. All right. So I think you would have noted it. So we then move on to the next case. That is part B. I will again modify the same question. I will again modify the same question a little bit. Let us tweak it. Okay. Uh, let us tweak it now. This is the third case. This is the third case. Okay. This is the third case. Okay. Now, in the third case, let me remove all of them. Okay, fine. In the third case, I am having equity share capital of say 10,000, P&L balance of 90,000. So this comes to 1 lakh. I am having on the asset side inventory. On the asset side, I will be having inventory of 1 lakh. This is fair value 1,20,000. This is fair value 1,20,000. Okay. Corresponding changes. You have acquired 100% stake not for 50,000 but for 1 lakh rupees. But for 1 lakh rupees. Okay. So on 31st March 2022, on 31st March 2022, you have sold, S Limited has sold this inventory. So 10,000 cash, it could sell it for 1,30,000. So P&L opening was 90,000, add profit. 1 lakh inventory you sold for 1,30,000. So this is 30,000, 1,20,000. So this comes to 1,30,000. This is the balance sheet on 31st March 2022. Okay. First understand the case and then we shall proceed further. Okay. So now the usual thing, prepare the consolidated balance sheets as on 1st April 2021 as well as 31st March 2022. Fair enough. So now let us come to the consolidated balance sheet, assets, liabilities, etc. Okay. And let us understand the workings. Okay. All right. So first we draw the consolidated balance sheet format, which is 1st April 2021. Then you are having a P Limited's balance sheet given to you. Then note number 1, assets, liabilities. Here I am having inventory of S appearing at 1 lakh. Inventory of S appearing at 1 lakh. And then you are having reserves of 90,000. You are having reserves of 90,000. Now, is this entirely pre-acquisition? Yes, because this is on the date of acquisition. So this would be 0 and this would be 90,000. Now, whatever be, you cannot say we will follow conservatism and we will stick to fair value or book value, whichever is less. You cannot say that my inventory is 1 lakh, fair value is 1,20,000. We will stick at 1 lakh because that is a conservative approach. Answer is no, you cannot. Why? Because Ind AS 103 requires you to do a fair valuation of each and every asset and liability. Even if it gives rise to an increase in the value of assets, record it. Because what we are looking at is not conservative accounting. What we are looking at is realistic accounting. If you have paid more value, don't put all that value in goodwill. If you can attribute that value to the identifiable asset, then please identify that asset and record it. You would have paid, instead of 1 lakh inventory, you've paid 1,20,000. That means the additional 20 you would have paid in your PC because the inventory is worth an additional 1,20,000. And therefore, we will again do a fair valuation of inventory. So add fair value of stock. increase. Okay, so this 1 lakh became 1,20,000. So this is increased by 20,000. So this comes to 1,10,000. Post remains nil. What is the journal entry for this? What will be the journal entry for this? The journal entry will be inventory account debit 20,000 to which P&L? Pre-P&L. To pre-P&L 20,000. One effect has gone in working note 4. The second effect of this pre-P&L, the first effect has gone to that. This inventory account, the effect will come to note number 1. So plus 20,000. So here 1 lakh plus 20, I will be having 1,20,000 appearing as your inventory. And now when I prepare the consolidated balance sheet, parent will come at 1 lakh equity. Investment in S is worth 1 lakh in the COC account. The equity share capital of S Limited is worth 10,000. Okay. The pre-P&L is worth 1,10,000, is worth 1,10,000. So when you balance this, you are getting a figure on the debit side. That is a credit balance, which goes on to show that you have actually got a capital reserve. And this capital reserve will come in the consolidated balance sheet, 20,000. And here you will be having inventory appearing at 1,20,000. So this comes to 1,20,000. This comes to 1,20,000. And that concludes your consolidated balance sheet. There is no mistake here. We have done everything absolutely correct. There is no harm, no mistake, nothing of this sort here. Okay. Is this part clear about inventory? This is very much the same as that of the figures that we had done in respect of the land valuation. Okay. So no change in this. This is absolutely right. Now we move on to the next part. That is the balance sheet. We have to create the balance sheet as at 31st March 2022. Now at 31st March 2022, two things are happening. First thing is this inventory is getting sold. Inventory cannot get depreciated, by the way. Okay. Inventory cannot get depreciated. This inventory is getting sold. As a consequence of this inventory getting sold, what are the two things which are happening? I am getting cash in its place worth 1,30,000. And this is giving rise to a profit of 30,000 in the standalone books of S Limited. This is giving a profit of 30,000 in the standalone books of S Limited. Is it clear? Yes. So when I proceed to prepare the consolidated balance sheet as at 31st March 2022, the picture is going to look something like this. Okay. The picture is going to look something like this. This building, cash, all these items will remain as it is. Okay. I'm just changing the figures now. That should take care of everything. Okay. Yeah. So okay. Now I have my pre-P&L, my P&L of 1,20,000. P&L of 1,20,000. This is on 31st March 2022. That is the date of consolidation. Now here the pre-P&L would be existing on the date of consolidation. That is worth 90,000. That is worth 90,000. So in the post, S has actually earned a profit of how much? S has actually earned a profit of 30,000 rupees. Actual May it has earned this profit. Okay. Now the question is, can I directly take this 30,000? Okay. Before that, there was a fair value adjustment. So my inventory went up by 20,000 and this became 1,10,000. The question is, can I directly move to do the valuation? Can I directly move to do the valuation of inventory and complete? I cannot. Why? Because now this inventory is sold. Abhi aapke balance sheet mein inventory hai hi nahi. What you are having right now is not the inventory. What you are having is cash. What you are having is cash. So parent mein to inventory was not there. Subsidiary also inventory was not there. But remember, this adjustment entry of 20,000 is still there. I have not eliminated it. This adjustment entry is still there. And you are also having cash of rupees 1,30,000. You are also having a cash balance of rupees 1,30,000. Is it okay? Fair enough. So now the problem arises. Do I take entire 30,000 straight away to the consolidated P&L? Answer is no, you cannot. Because out of 30,000 worth of post-acquisition profits, I have already recognized this 20,000 on the date of acquisition itself. Why? Because that was by way of a fair value adjustment. That was by way of a fair value adjustment. Just look at how the things are going to pan out now. In the standalone P&L, the inventory looks something like this. Inventory 1 lakh, sales 1,30,000. So you have earned a profit of 30,000. This is how the inventory position is looking at. Ultimately, when it is sold, the closing stock is going to be 0 and your profit is going to be 30,000. But in the consolidated P&L, on 1st April itself, you have revalued this inventory to 1,20,000. Why? This revaluation was done pursuant to Ind AS 103. So I have already recognized this 20,000 profit. Now this inventory is being sold for 1,30,000, giving no closing stock, leaving no closing stock, and therefore the actual post P&L for the consolidation purposes should be 10,000. Sir, where did that 20,000 go? Difference between 30 and 10. Arey Baba, that was recognized when the fair value movement happened. Then why was it not recognized in the case of S Limited standalone? Standalone may not needed. See, standalone, you have to recognize at cost or NRV, whichever is less in accordance with Ind AS 2. That is what S Limited has done. So S Limited standalone is not incorrect to say. It is not incorrect. At the same time, I cannot record a direct 30,000 gain because that would amount to double accounting of the profits. 20,000 on the date of acquisition and 20,000 once again when I am recording the post P&L. And therefore, I will have to reduce this. Okay. So here I will deduct less profits recognized on the date of acquisition. How much is that profit? It is 20,000. So when I deduct this, I will be left with 10,000. What is the journal entry for this? The journal entry for this is going to be post P&L account debit to inventory. Post P&L account debit to inventory 20,000. Okay. This is the journal entry that we will pass in the consolidated books. And what will be the effect? Well, this inventory will go to note number 1. This goes to note 1. And post P&L has already come in working note number 4. Yes or no? So here note number 1, I had added 20,000 when fair valuation was done. Now the sale is happening after the acquisition period, for which I am de-recognizing this profit of 20,000. And therefore your inventory balance will come to 0. And this will remain at 1,30,000. This will remain at 1,30,000. Standalone profit is 0. But there is a post-acquisition profit of rupees 10,000, which is now going to come to P Limited, which is now going to come to P Limited in the consolidated P&L. So ultimately, your consolidated balance sheet is going to look like this. 1 lakh rupees is going to be the equity capital, your equity share capital. Then I am going to have P&L, consolidated P&L. Did not have, there were no what you can say reserves of P, but this 10,000 gets added. So I will have 10,000 coming to the consolidated P&L. I had a capital reserve. Is that going to change? Why will that change? That remains at 20,000 only. And finally, I will be having cash appearing at 1,30,000. And that kind of completes my consolidated balance sheet. That completes my consolidated balance sheet. I have recorded the fair value adjustment on the date of acquisition. That will help me to arrive at the goodwill correctly. Because 103, when you calculate the goodwill, you would take the fair value of assets and liabilities. And therefore, here also you are going to take the fair value of assets and liabilities. When this inventory gets sold, you are going to record it at whatever proceeds you received. However, the profits that were initially recognized on the date of acquisition as a fair value adjustments, to that extent, I am going to reverse those profits. Acha sir, what if this inventory was not sold? If this inventory would remain as it is? Okay. So if this inventory would remain as it is, ye cash nahi aata, this cash would not come, number one. This consolidated P&L would not come. Instead, I would have the inventory appearing at 1,20,000. No change, no change. In the standalone P&L, would there be any profit? There would be no profit because no sale has happened. Opening stock of inventory 1 lakh, closing stock of inventory 1 lakh. There would be no change, no standalone profit, no consolidated profit. So inventory tha 1,20,000, it will still continue to appear at 1,20,000. Is it okay? So that is the case if the inventory were to be held and not sold. If it is sold, the picture would be how we had discussed earlier. Okay. So 10,000 and 1,30,000. So we have to be very, very careful to see what is exactly happening in the post-acquisition period. And what happens in the post-acquisition period? If there is a sale, reverse it. Why? Because the profits were already recognized on the date of acquisition. If there is no sale that is happening, then at that point of time, you would just hold it as it is. There would be just a pre-acquisition reserve adjustment, and that would conclude my question. Okay, so this is how we are going to do fair valuation adjustments relating to inventories. Fair valuation adjustment relating to inventories. Okay, inventories cannot be depreciated. So there are two options. Either it is sold off or it is unsold. Okay, or it is unsold. Whether it is sold or unsold, do I have to do the fair value measurement on the date of acquisition? Definitely. There is no choice. It does not depend on whether you sell the inventory or not. The event is a business combination, and therefore we have to do a fair value adjustment regardless of whether the inventory is sold or it remains unsold Okay. So we will write this theory for inventory. We have already written the theory for property, plant and equipment. We will write the theory for inventory. We will write the theory for inventory. Now, inventory looks something like this. This is the initial adjustment that is on the date of acquisition. Subsequent adjustments, if it is sold or unsold. Okay, if it is sold or unsold. Okay, all right. Now initial adjustment it would be inventory account debit to pre-P&L. Where would these items go? Inventory adjustment goes in note 1, whereas pre-P&L item goes in working note number 4. It goes in working note number 4. Assuming initial upward. Assuming initial upward. Fair valuation of inventory needs to be done regardless of whether such inventory is subsequently sold or not. This is to ensure that goodwill is calculated correctly on the date of acquisition in the COC account. Okay. Subsequent adjustment, two things could happen. Unsold. If it is unsold, no further adjustment. बैठे रहो ऐसे ही जब तक बिकता है. Okay. If it is sold, then I will have to reverse through the post P&L. So post P&L account debit to inventory. So where will this go? This will go in working note 4. This will go in note 1. This will go in note number 1. This will go in note number 1. Okay. Acha, what if there is a downward revaluation? It is going to be exactly opposite. Okay. Pre-P&L account debit to inventory initial downward. And what will be the adjustment? If this remains unsold, no further adjustment. If it is sold, same entry, recognize the reversal of it. Inventory account debit to post P&L. Okay, so this is note 1. This is working note 4. Okay, so that takes care of your adjustments related to inventory. Okay. that takes care of adjustments, fair value adjustments related to inventory. Okay. All right. Fine. So now I will be giving you a homework. Try to solve question number 11 of this sheet. Okay. I will be doing it up on Tuesday. Our next class is on Tuesday. I will be doing it on Tuesday. But if possible, try to read it, solve it, and we will be in a better position to understand. So the format is put up for you. Question number 12. Try to do question number 12 for me. You should not find any difficulty. If you go one step further and do question 12 also, I will be happy, but at least try to solve question number 11. Question number 11 is nothing but fair value happening on the date of acquisition, and you have to prepare the consolidated balance sheet on the date of acquisition itself. So that is what you will do. Question number 12, same question, but 1 year later. You can see this is 31st March X2. This is 31st March X3. So first question, question 11 is fair valuation done and prepare the balance sheet on the same day. So try to do it. Okay. I have given these examples. Try to do it. I'm optimistic that you will get it. Okay. 31st March 20X3, the next year, you can try that also because it is a continuation of the same question. If you get it, it's excellent. If you don't get it, no problem. I'll be doing both the questions on Tuesday. It's just that you will be in a better position to understand and we can go a little bit faster also. Okay. There is one more point that is left, which is payables. Okay. We'll be discussing that on Tuesday. Okay. If any company following, okay, so I have a question. If any company following Ind AS acquires a company following IGAAP, then the acquired company has to follow Ind AS. Okay. So first you convert it to an Ind AS and then you do the consolidation. Okay. So first you convert the balances, etc. to Ind AS. You will take certain exemptions that are there. Okay. You will take certain exemptions that are there available, and accordingly, like the previous IGAAP values of property, plant and equipment, you can straight away populate it for the purposes of property, plant, equipment values, opening balances for the purposes of Ind AS 16. So you have these, what you can say, relaxations which are given under Ind AS 101. But later on, when you have done the acquisition, you will have to ultimately do a fair valuation accounting. If you don't want to take the efforts in fair value accounting at the time of consolidation, do the fair valuation at the time of transition itself. No problem in that. Okay. No problem in that also. Okay. So that is how you are going to do. So today's discussion as such is done. K. Shivashankari, I hope you are there. So you had a query about this. So this question is related to K. Shivashankari's doubt. NCI at fair value. This was the query that Shivashankari had. What she is asking is, if we record the NCI at fair value in the consolidated balance sheet, the goodwill of NCI is included in it. It's not like that. NCI at fair value is nothing but number of shares held by NCI multiplied by market value of shares on the date of acquisition. This is NCI appearing at fair value. इधर किधर भी goodwill नहीं दिखता अपने को. There is no goodwill that is there here. This is a plain market calculation that is there. Okay. This is an alternative one. This is an alternative one to calculate. Now, why this NCI at fair value is preferred? Why NCI at fair value is preferred is because this represents the NCI, what you have to pay to them physically to get their shares. Okay. So this represents actual payment to be made to NCI to acquire their shares. Now, when you are actually going to pay to the NCI, they will say, sir, this share is not worth only the value of assets. This share is not worth only the value of net assets. It is worth more than that. And therefore, you will pay that fair value. That fair value is not equal to net assets. This is the market's sentiment of the value of that company. This is the market's sentiment of the value of that company. Okay, this fair value means the market value. And therefore, it will typically be higher than the net asset. If it is a good company, typically the market value per share is going to be greater than the net asset per share. It is typically going to be greater than net asset per share. And therefore, you are paying a higher value. Now, this higher value is ascribed only to the NCI. This higher value is ascribed only to the NCI. When you are the parent, we prepare the cost of control account. Now, suppose you are a parent and you are a prospective parent. Let us assume prospective acquirer. You are looking for targets. You are scouting for targets. You are scouting for companies which you can acquire. Now, if you are looking for companies which you can acquire, suppose there is a company A Limited. A Limited is held by a number of shareholders. So you, the company, will approach these shareholders and tell, sir, we want to acquire this company. Do you think these shareholders will give the shares at fair value? That is the market price. Do you think these shareholders will give the shares at market value? Answer is no, they won't. They can never give the shares at market value, because when you are acquiring a control, what you are acquiring is not just the shares, but you are acquiring the shares plus a right to control. And therefore, what you will be paying is something known as market value plus a control premium. This control premium results in your goodwill being higher than the goodwill attributable to the NCI. Always. In that question which we did, it was an aberration of figures where we got COC as 1000 and goodwill attributable to NCI as 1500. It is an aberration of figures. But in real life, goodwill applicable to the parent will always be high because of this control premium. What the parent does is, it will typically go and pay more than the market value. In fact, if you look at the acquisition of L&T and Mindtree, if you look at acquisition of Larsen and Toubro, which acquired Mindtree, they gave a sizable premium over the market value to acquire a controlling stake. You must be aware that it was a hostile takeover. It was not so easy. So they slowly acquired shares from K. Siddhartha of Cafe Coffee Day. They acquired another 2-3 for institutional investors share. And ultimately, when they came to the public and said, we want to acquire the shares, but the shareholders will say, why should we sell it at a market price? So L&T priced the takeover at a value greater than the market price. Why? Because L&T wanted to take control over Mindtree. They thought that Mindtree was a very good target, and therefore they went and gave a price higher than the market price, which many shareholders accepted, and that is why L&T was successfully able to acquire the shares. Now what L&T has done, L&T paid a value greater than the market price, and that is why the goodwill attributable to L&T would typically be greater than the goodwill attributable to NCI. And that is why I cannot say that this NCI at fair value includes goodwill. So why to show goodwill separately? That is not the line of argument. This NCI at fair value is a balance. This is the market value of NCI as on a particular date. Because I am taking that market value, because that market value is greater than the net asset value, there will be a goodwill balancing figure. So therefore, I will be having market value of NCI appearing as the closing balance, and I will be having the goodwill attributable to NCI forming a part of goodwill. In that example which we discussed the question, the NCI was appearing at 16,500. The goodwill attributable to NCI was 1,500. That does not mean I can net it off and show it as 15,000. You can net it off and show only when you intend to settle it on a net basis. Here my intention is to show this at 16,500 only because I am following the full goodwill approach. It is an accounting policy choice, and therefore I cannot say that 16,500 includes 1,500, and therefore if that is the case, you have to show your NCI at 15,000. If you show it at 15,000, then you are following proportionate share of net assets, in which case the goodwill attributable to the share to the parent company alone will come. So alternative 1 is NCI at fair value. Alternative 2 is NCI at proportionate share of net assets. NCI at proportionate share of net assets. Isme forget the fair value. I am acquiring the company. My share is 80%. So net assets mein whatever is attributable 20% to NCI, show it as NCI and finish it off. In this case, NCI is exactly valued at net asset share. Exactly. So will there be any goodwill? No goodwill, because NCI at net asset is equal to the net asset share. कोई difference नहीं है, and therefore will I have goodwill attributable? I will not have the goodwill that is attributable to the NCI, and therefore here I had recorded it at 15,000 NCI with no corresponding goodwill. My intention is to show NCI at proportionate share of net assets, and that is why we will do the accounting as such. Otherwise we need not follow alternative 2, we can do alternative 1, in which case my NCI appears at the fair value or the market value, and I will also have the goodwill attributable to the NCI, which is ultimately totaled with goodwill attributable to the parent, and it goes as a single consolidated goodwill figure in the consolidated balance sheet. Is it okay? I think I have tried my best to explain what is this NCI at fair value and how do I do the accounting? Why do I do the accounting? Okay. So that should at least sort out your doubts, K. Shivashankari. Let me know if you haven't. Okay. You can always reach out to me at fr-final@icai.in. Okay. So we conclude our session with this discussion. We will then continue on Tuesday. Try question numbers 11 and 12 for homework. You should be in a position to solve them with the adjustments that we have done. Okay. So we close the session for today. Thank you. Close the session. Yes. Ram?
Ram,